required part, they are telling us as a newly recruited accountant, you advise the finance manager on how the above grants should be accounted for in the statement in the financial statements for the year ended 30th June 2020. Clearly give the financial statements extracts, okay, using income approach of the accounting for government grants. So we are going to read it through, but before we even read it through, just to highlight about this standard, always know that when you're talking about grants, government grants, you need to first know whether the grant is conditional or unconditional. IAS 20. It's good to know whether the grant is, we have conditional grant and unconditional grant. If it is conditional grant, it means that there are some things you must first fulfill. There are some conditions that must be satisfied. With unconditional grants, there are no conditions, as you can hear. There are no conditions as long as they promise you that you're going to receive a grant, you immediately recognize. But here you only recognize the income once you meet the conditions. It's very, very key. It's very, very key. Here you recognized income statement when conditions have been fulfilled. That's with the conditional grant. Then unconditional, you recognize the grant, recognize the grant at the point when it becomes receivable. What do we mean? You have established that you are actually going to receive a grant here. You have established, or you have confirmed that you're going to receive grant. Immediately, you recognize that grant as receivable. The same way you see debtors, they have their money at any time you expect to pay back. So here, even if you have not yet received, but once you confirm that you're going to receive the grant, then you recognize. But here you only recognize once conditions have been fulfilled. Okay. Yeah, that's something you needed to understand. Okay, let's just read through the question and see. That question. They are telling us that a tree farming limited, yeah, that is TFL, is a company that deals in the planting of different varieties of trees in northern Uganda. During the financial year 2019-2020, TFL was earmarked by the government of Uganda as one of the farming companies to benefit from the government extension program. On 1st December 2019, TFL received a grant of 100,000 tree seedlings and tree planting equipment. So here you have two things. You have tree seedlings and tree planting equipment from government as part of the program. Okay. The seedlings have been supplied to the government. The seedlings have been supplied to the government at shillings 5,000 each by Eastwoods Limited. To deliver the seedlings to TFL's farm in Iguru, EWL incurred shillings 500 per seedling. Okay, this money has not been incurred by TFL. It was incurred by EWL. Okay, the fair value of the tree seedlings was equal to their selling price at the time of delivery. And the market value of the tree planting equipment was shillings 150. This is remember, this is another item, okay? 150 million. The equipment's useful life is 15 years as per equipment specifications and the user guidelines. Okay. The conditions of the grant, this is very key, colleagues. The conditions of the grant required half of the seedlings to be planted. Half of the seedlings to be planted by 30th June 2020. Otherwise, be returned and given to other farmers. So it's very, very key. You need, as you read the question, you need to know was this condition met or, okay? As of 30th June 2020, okay? Remember, we are preparing this as at 30th June 2020, okay? They are telling us that as of 30th June 2020, TFL had managed to plant 70,000 seedlings. You remember you had how many? From the question, you had how many? The grants seedlings 1,000. Out of 1,000, by 30th June, you had planted the 70,000. Remember, the condition is by 30th June to have planted half. So it means that already you have met the condition. Okay. The finance manager of TFL is in the process of preparing financial statements for the year ended 30th June 2020 and has approached you for the advice. So you have this. So colleagues, you see in this question, you have two items. You are looking at tree seedlings. At the same time, you are also looking at the tree planting equipment. You have to talk about each separately, but in your financial statements, you agree, you put them together. Okay, because tree seedling, these are accounted for using IAS 41 tree seedlings. These are plants and the plants. So you have to account them using that IAS 41 agriculture. So let's write something. So we have mixed here. We are going to look at two standards. That is the IAS 20 and the IAS 41. Okay. You have, let's start with tree seedlings. These are biological assets. That must be accounted for. And IAS 41 agriculture. Okay. Remember, biological assets, this standard requires us to initially and subsequently measure This standard requires the biological asset to initially and subsequently measured at fair value less point of sale costs. Okay. Okay. So they will say they will be measured. They will be measured at fair value less point of sale costs. Like here, we are trying to mean at the point when they are ready for harvest. At the point when they are ready for harvest. Okay. So using our question, you can see that if you're talking about tree seedlings, remember we are in the books of TFL. Okay. And you observe that on 1st December 2019, this TFL received a grant of 100,000 tree seedlings. But somewhere they told us that the seedlings have been supplied to the government at shillings 5,000 each. So it means that you can get the fair value. Then ask yourself, do you have the point of sale costs? When you observe in our question, they just told us that to deliver the seedlings to TFL's farm in Guru, EWL incurred shillings 500 per seedling. So colleagues, you see, you ask yourself who incurred this money. You incurred this money. We are not dealing with leases. IFRS 16, where you talk about lease incentives. This is IAS 41. And the point of sale cost must be incurred by the company you're talking about. Okay, these costs were incurred by EWL. They were just costs to deliver to the destination. Okay, and they were not incurred by you. So you will not, you can't bring in the costs that were incurred by another company. So it means that for this, we don't have the point of sale costs. So it means that for you, you're going to recognize the value of tree seedlings, the value of your biological asset, tree seedling. This is biological asset. You're going to recognize this by getting the cost, the fair value, which is 100,000 times 5,000. That is the selling price. 5,000 is the selling price. Then we subtract the point of sale costs we don't have. So finally here you get how much? This is the shillings, 500 million. Okay. Then we are going to say that under IAS 41, for grants, for government grants related to agriculture activities, agricultural activities. That is biological asset. The entity, okay, requires an entity to recognize the grant the grant in PL, in the PL, if the conditions attached to it have been fulfilled. This, remember, this is conditional grant. This is conditional grant when you read the case study. So because it is a conditional grant, for us to recognize this grant in our PL, the conditions must have been fulfilled. Okay, in this case, okay, we are going to say that in this case, the grant income must be recognized in the profit or loss account. It means that here we are debiting the biological asset, our asset, the biological asset, that is the biological asset. Remember, biological assets appear in our balance sheet. Debit our biological asset, that is the tree seedling, by how much? 500 million. Then we credit the income. Okay, we credit PL account, that is grant income. This is grant income because the conditions have been met. Okay, so that's all about this tree seedlings. It means that when you're doing your extracts, this one will appear in the balance sheet. This one will appear in your income statement. Okay, so we talk about also the tree planting equipment. The tree planting equipment. Remember, we had the two grants. One related to tree seedlings and another one related to tree planting equipment. And when you observe in our question, they told us that on 1st December, okay, let me see. Yeah, you received the grant from the government. The fair value here, the fair value of the tree seedlings were equal to their selling price. Okay. Remember, here we don't consider the selling price. For us, we look at the fair value. What is the fair value? What is the fair value of the tree seedling as at that date, at the time you're receiving that biological asset? Okay, for us now, for transaction number 2, we need the tree planting fair value. Let me see, and the market value. Okay, the market value of the tree planting equipment was shillings 150. Okay, and the useful life is 15 years. So what are we going to do here? We are going to say that here, that is the market value. The market value as at on 1st December 2019, it was shillings 150 million. 150 million. Okay, and they are telling us that the useful life here, it's what? 15 years. Remember, you're using income approach. Okay, so what you're going to do, you're going to say that according to the income approach, The entity, that is TFL. TFL recognize, must recognize the grant income on a systematic basis of that is over the period that the entity incurs the related costs. That is with the income approach. It means that here initially that is on 1st December 2019. What should be done at the point of getting that asset? What should be done at the point of getting that asset as a grant? You debit. Here you debit, that is the asset. It's not a biological asset here, it's a PPE. It's an asset. This is a tree planting equipment. So at that point, you debit your asset, 150 million. Then you credit what? You credit deferred. Now you introduce something called deferred. Remember, you're going to use this asset for what? For 15 years. For 15 years. So we ask ourselves, what is the income you're going to generate in the first year, in the second year, in the third year? You keep on allocating. So you call it deferred grant income because at this point you have not started using the asset. This asset has not started generating what? Our income, okay? So you credit, it's a deferred. Now, what does this one mean? It means that subsequently, this approach, income approach, requires you to allocate this on a systematic basis. It means that on each year you're supposed to, okay, what we are meaning, subsequently, what should be done is that you're going to recognize the grant income. Subsequently, the grant income for the year. Now we are handling which year? For the year ended 30th June 2020 should be what? You simply get that deferred grant income 150 million. Then you divide by what? Divide by the number of years, 15 years. That is each year you should be recognizing this. However, when you look at our question, remember you received this. You received this on which date? You received this on 1st December 2019. You received this on 1st December 2019. So it means that the year is going to end when you have just used the asset for a period, not full year. So you count the number of months from 1st December to 30th June. How many months are those? So here it looks like these are 7 months. So it will be 7 out of what? 7 out of 12. Are they 7? Yeah. 7 out of 12. December, January up to June. Those are 7 months. Okay. Then what do you get here? This will be shillings. Tell me, what do you get? This will be shillings. 5.38 million. You may be asking yourself, why didn't we apportion this? Here you don't. Here it is just conditional. This is just conditional with biological asset. This one is conditional. As long as you meet the condition, you recognize. But here it's an asset, and with an asset, if you receive a grant as an asset, then as long as you're using income approach, we are saying that income according to how you're using the actual income to that time. Okay, that's why I'm allocating it 7 out of what? Because you have not used the asset for the whole year in that time frame. So it means that the remaining balance will be like a liability, as we are going to see. Okay, let's continue for now. Please, if there is a question you ask, if you have a question you ask, so in our income statement for the year ended 30th June 2020, we are going to recognize this as well. This will be an income. So it means that here, it means that you're reducing this liability. Like the entry you can make here is you debit, you reduce the liability. Remember, deferred grant income is a liability. It's a liability. So you debit deferred. Now you reduce that liability, deferred grant income, in short. That is like the liability account. You debit by 5.83 million. Then you credit now the actual income. Credit the actual income, PL account. This will be grant income for the year. 5.3 million. PL in our extract of profit or loss. But you see, we are dealing with an asset. And because we are dealing with an asset, colleagues, here, because we are dealing with an asset, then we must also depreciate. And at the same time, we must get the carrying value as at the date we are preparing balance sheet. So it means that still, subsequently, you need to depreciate. We need to get the depreciation expense. The depreciation expense will be what? The cost divided by useful life. What do you get? It's the same, I think. This was 150 million divided by 15 years. So the depreciation per year is 150 divided by 15. That is 10 million. This is per annum. However, you see, okay, it's okay. However, you see for the year ended 30th June 2020, the depreciation will not be for the full year. You'll also have to time a portion. You have to time a portion. For the year ended 30th June 2020, the depreciation here, the depreciation expenses will be equal to that 10 million times only 7 months, 7 out of out of 12. Because this is for the full year, but you have not used the asset for the full year. Okay. So you get the same figure, 5.83 million. Okay. That is for the full year, or rather for the 7 months. Then add to that date still the carrying value of tree planting equipment will be equal to the cost minus accumulated depreciation. And the cost is 150 million minus what? Minus accumulated depreciation, which is only now the depreciation we have is only 583 million. But you see, sometimes assume you're handling a question for the year ended 30th June 2024. For the year ending 30th June 2024. It means that here you must get the accumulated depreciation from 2019 to 2024. The depreciation each year is 10 million. So if you're looking at 4 years, then you multiply by 4. So here the carrying value is what? 150 minus 5.8 million, which is shillings 144.17 million. So it means that for the year ended 30th June 2020, you must recognize this in your balance sheet. You must recognize this in your balance sheet. So we are done with that. What is left is just to recognize in our extract. Okay, so let's make our extracts. Pay attention with extracts. We can start with extract of PL, profit or loss, and other comprehensive income for the year ended 30th June 2020. These are just extracts. You just need to put things from your information here. What are the things that are going to appear in this PL? Here you have only other incomes because grant income appears under other incomes. Okay, so under other incomes we will have the grant income. The first grant income was what? Here you see this one, 500 million. You recognize that this was from your biological asset. That is tree seedlings. Okay. This was 500 million. You can say millions, shillings in millions. Okay, then we have another grant income. The one related to tree planting equipment. Which one? The actual income, not deferred. Don't mix these two. The deferred one is not, the deferred is the liability. This is the liability. So for you, you're looking for the actual grant income that must appear in PL. This one So it's what you're going to record, 5.3, 5.83. I think that's what we have, but still we have expenses. Here we have expenses as well, but we have only one expense, the depreciation for this financial year, this one. Okay, so the depreciation expense, that's the depreciation of tree planting equipment. And what was that depreciation? This one, 5.83. What else? We are done with that. We are done with extract of what? Profit or loss. Then we look at extract of statement of, yeah, add another word, extract of statement of what? Extract of statement of financial position. Statement of financial position. Add that here you use add that 30th June 2020. So what should appear in your balance sheet? From the information you have from your transactions, first you have a biological asset, tree seedling. So it means that here we have non-current assets. You have non-current assets, and with non-current assets, you will have your biological assets. These ones relate to tree seedlings. Then biological. Then this is biological. This was 500 million. So then we have also what? You see this? This is an asset. This is an asset, PPE. So it must appear here. But at its carrying value, it must, remember we record this in our non-current assets at carrying value. So here PPE, it will be the tree planting equipment. Please, you record the carrying value. What is the carrying value? The carrying value is this. Because of the depreciation, remember this was added, this figure was added at 1st December 2019, but we are reporting here 30th June 2020. It means that the value has reduced because of depreciation. Okay, so it is what 144.17 million. So those are the only assets we have. Then with liabilities, you will have non-current liabilities. Remember, colleagues, this is a liability, deferred grant income. Now, what does this one mean? What does this one mean? It means that when you're dealing with these, colleagues, it means that you will create a non-current liability. You also create a current liability. And I'm going to explain this too. Non-current liability. You will have deferred. deferred grant income, or you can say deferred government grant, and also you have deferred deferred grant income. Okay, how are you going to get the figures? It's very easy. It is 150 million divided by 15. So it means that here, each year you should be recognizing this per year. Okay. However, when you observe for this year, you recognized the grant income. Your liability reduced. Where there's somewhere where we made here, our liability, this liability reduced by this figure. Okay, so it means that one, the year is going to end. The year is going to end. Nga for you here, your liability is you get that 150 minus what you have actually recognized for the year, 5.8. 5.83. This is what we recognized as an income. So the balance is what? Tell me the balance. That is 150 minus 5.83. The year is going to ending your balance. Your total liability is this. But this total liability must be split into two. This total liability must be split into two. This must be split. This must be split into two. Into one, a current liability. The same way with leases, how we split the total liability. Then here, non-current liability. So what will be the current? The current liability is the one you expect to recognize in the next 1 year. What do we expect to recognize in the next 1 year? And we know that each year the company recognizes 10 million. 10 million as an income. So it means that every year the liability is reducing by 10. Every year is reducing by 10. So it means that here the current liability will be 10 million, the one you expect to recognize within next 1 year. This one. Then the non-current liability will be the remaining balance, 144.17 minus 10. Because you're recognizing this in the next year, you have not yet recognized it. That's why it is a liability. But once you recognize it next year, it will not be a liability. So that's how you will always deal with this. So it will be here, the current liability will be the 10. Here, don't time a portion here, colleagues. Why you don't time a portion is because here with balance sheet, you are looking at a period of actually for the next 1 year as a liability. What will be the liability for the next 1 year? And how do you know that liability? You just look at what? You just look at what should be recognized each year from your deferred computation. I did this here. This will be grant income per year, per annum, per year. This one must be recognized. Here we time apportioned because it was the first year. It was the first year, and in that first year, we had used the asset for only 7 months. That's why we had to apportion. Okay, so with take note with liability, we don't time apportion. If it is a current liability, this one we don't time apportion. You just get the deferred grant income, the total divided by the year, the number of years. What you get is your current liability. Then the balance, deferred grant income, it will be what? The balance here. What is our balance? This one minus this. This one minus that. That is what? For this thing, you are very quiet. That is 134 point this. And that's all. That's really all. That's all. That's all. That's all. That's what must be. That's what must be done. Assume you were going to recognize, to do extracts for their ending. For their ending 30th June 2021. What should appear here? What should appear here? What should appear here? And of course, also these ones will change, especially this one will change. What will appear here is what? Of course, you'll first know what is the income, the grant income for the year ended 30th June 2021. That grant income will be what? Because it is a systematic, you will recognize 10 million as actual. This one will appear in the PL. That one must appear in the PL. So it means that the liability has reduced. The total liability, this one, you keep on monitoring the total liability. It means that total liability has reduced by again 10 million. So it means that in the balance sheet, now you have the total liability. What? Total liability will be what? Total liability will be initially, previous year, the liability stood at this 144.7. 144.17 minus now that liability has again reduced by 10 minus that 10. So the total liability is what? 144.17 minus 10, which is 134.17. Okay, that is the total liability. But this one must be split into two. Split into the current. So it means that for the year ended 30th June 2021, your current liability, this one will remain constant. Current liability will remain as 10. Why 10? Because every year you expect for the next 1 year to recognize only 10. Then the non-current liability, will be what? 134.17 minus 10. That will be your non-current, which is 124.17. That is, you keep on doing like that. Even like 2022, you do the same. In 2022, you ask yourself now in 2022, what is the current liability? What is the total liability? Actually, in 2022, the total liability will be this, which must be split again into two. Current, which is 10, then non-current, the 124.17 minus 10. You keep on doing that because in 2022, you will again recognize an income of 10 million. So I believe when you meet this question about IS 20, you will not fail. Okay, so I'm done with that question. Okay. Remember, as you do this, colleagues, as you do all this, also keep in mind that the carrying value, this one must be changing for every year because you're depreciating this.